Welcome to the Fear and Greed Daily Interview. I'm Sean Aylmer. It's been a brutal few days for equity investors with the local market hammered over inflation fears. It's a good time to speak to Brycki, founder and CEO of online investment advisor Stockspot. Remember, this is general information only and you must get professional advice before, well, you mustn't, but you should get professional advice before making investment decisions. Chris, welcome back to Fear and Greed.
Thanks for having me back on, Sean.
So, how would you characterise the last, well, it's almost a week. I suppose it's late last week when the US inflation figures came out, and then Australia got hit really hard on Tuesday in particular. But how would you characterise the last few days?
Well, I think it's just all become quite apparent now that inflation, in the US and everywhere really, in Australia as well, is staying higher than expected for longer than expected. And now markets are anticipating that central banks will just be forced now to increase interest rates both faster than they're expecting and also higher than people are expecting. So interest rates in Australia, unbelievably now, are expected to be well over 3.5% in a year's time. And now investors are worried about, what will that mean for consumers' ability to spend? They're going to be putting a lot more towards their mortgages. How can they still spend on other discretionary items? And will it actually tip economies into a recession? And I think that's what's led markets to become a lot more volatile over the last few days.
Okay, so is the pointy end of what's happened in the last few days or the last week or so, is it the fact that inflation looks to be here for longer, which means interest rates might have to rise more?
Well, it's the interplay between the two. So inflation on its own, is one factor, but it's the response of central banks to basically counteract and curb inflation that actually has a bigger impact on asset prices. And at the moment, markets are betting that central banks will actually act quite aggressively and push up interest rates well into the 3.5%. I think in Australia now it's now expected to be 3.8% by the end of next year. What could actually help asset prices is if interest rates start going up and it actually hurts the economy so much that central banks are forced to stop increasing interest rates. Yeah. So ironically, if interest rates go up too fast and too far and it tips economies into a recession, that could actually help markets.
How difficult is it to be an investor at the moment?
I mean, it's not difficult to be an investor. It's always difficult to predict the future. But
yes.
What it basically shows is that people, shouldn't be hung up on trying to predict what's going to happen next. It is so hard to predict, what's going to happen to inflation, how central banks are going to act, what is it going to mean to asset prices. And it's the reason why we don't advise that to our clients. We make sure they have a spread of different assets and they're able to withstand all sorts of different environments. So I think if you're someone that has all your money in, a sector like buy now, pay later that's fallen 95%, absolutely, you should be stressed. But if you're well diversified, there's really nothing to worry about.
I suppose that's the question. I mean, I'm sort of the same question in a different way. How difficult is it for investors to hold their nerve? Is it about making sure you've got the right portfolio going into these times of turmoil?
I think it's a combination. One, you need the right portfolio going in and you need to have some historical context on what's a normal sort of market fall. So if you've been someone that's only ever had cash in the bank and you experience a market fall of 5 or 10%, it might feel like a big market fall and lead you to want to take your money out. But knowing that happens, once a year or so, we've found helps to calm the nerves of clients. So partly it is your asset allocation and making sure that when markets fall, you're not falling by 60% or 80%, which is pretty hard to withstand and have a conversation with your family and partner about, but you're only falling 5 or 10 or 15%. But then it's about the advice you get because, even the most experienced investors we find get nervous and they need someone to speak to. And that's part of what we offer is advisors that they can call and actually have a chat to and provide some of that context. And so people are less inclined to make the mistake of selling when markets have fallen.
And of course, in these periods of volatility, there are opportunities as well.
There are. I mean, one of the big opportunities that comes about whenever markets are volatile that we see is rebalancing. So that's the opportunity to sell something that's done a little bit better and reallocate it into an asset that's done a little bit worse. So at the moment, what we're seeing is global shares have been really felt the brunt of these sort of inflation fears, and US shares are down 20% or so. US tech shares are down 30%, whereas other asset classes are actually doing a lot better. So gold is roughly flat on the year or up a couple of percent. And so there are opportunities to trim from one place and reinvest to buy cheaply in another.
Okay, so this isn't an investment advice podcast, so find an advisor, as we always say. But using that as an example, you might sell out of gold holdings and buy into tech. That's what rebalancing means?
That's right, and not entirely, Sean. So it's not like you're selling all of your gold, but you might be, trimming 10 or 20% and reinvesting. And that process of reallocation, what studies show is that it helps to reduce risk in your portfolio over time. And so we don't actually do it very often. In fact, there's many years that we don't do any rebalancing at all. But then in really volatile years, 2020 was a good example where we did two big rebalances in one year. You get opportunities to take the other side of people's fear. So when everyone's, jumping out scared, you actually get to buy their shares cheaply. And on the flip side, when everyone's too bullish, and perhaps 2021 was a good example there, when everyone was too excited about, a lot of the tech companies that were benefiting from work from home, that's where actually you're selling a little bit.
Stay with me, Chris. We'll be back in a minute. I'm speaking to Chris Brycki, founder and CEO of online investment advisor Stockspot. Okay, now shifting just a little, you've just launched the 8th annual Stockspot ETF report, looking at the performance of exchange-traded funds over the past 12 months or so. What are the main findings for ETFs?
So ETFs is this fantastic area of the market that, I've been a huge fan of since I started Stockspot. It's a way for everyday people to just access broad markets and invest in them at a very low cost. And what you've seen over the last 8 years, and it's really accelerated since 2020, is just phenomenal growth in the amount of money invested in these. So in 8 years, they've grown from having 13 billion invested in them in Australia to 130 billion. So they've 10 times. And actually, we found that in the last year, it's the first year that they've actually made investors $10 billion of profit. And a lot of that comes at the expense of traditional fund managers where people are yanking money out because they're not really performing very well, as well as people buying direct shares. So we're starting to see a lot fewer people going and buying Telstra and Woolworths because you can get a much better diversified portfolio by just buying an ETF instead.
Yeah, and the idea here is that you might buy the top 20 stocks on the ASX, but you might also buy gold companies, or you might buy, medical equipment companies. There are all sorts of ETFs around the world, aren't there?
Yeah, that's right. For instance, to invest in global shares, we recommend an ETF to our clients that gives you exposure to the 100 biggest companies in the world. So some are in the US, some are in Switzerland, in the UK, and you share in the profits of all of those businesses. So they're great because if you went to a fund manager in the olden days, you would have to pay a fund manager fee of, let's say, 1 or 1.5%, a platform fee of maybe 0.5%, and then pay an advisor another % or 2%. You're already behind the 8 ball by 3 or 4% before you even get started, whereas ETFs are really bringing down the cost and actually helping investors earn more of the return themselves.
Okay, now not every ETF is the same though. There's sort of simple index ETFs, which are exactly as is described. There's also active ETFs.
That's right. So the original trend in the ETF world, back probably 10 years ago, was for some of these big, broad market ETFs to come out where you can invest in the whole ASX 300 or the S&P 500 in the US. But over the last few years, the trend has now shifted for new products where they're focused on either active funds or more niche thematics, I would describe them as. So you can invest in hydrogen energy stocks, for instance, or cryptocurrency miners. And these are ETFs that we're a little bit more cynical about because they tend to launch around the peak of their excitement on the market, so when everyone's already interested in them. And particularly over the last year, some of these exciting, they're often described as megatrends, have been big disappointments, and some of them have fallen by as much as 80%. So we actually steer our clients well away from these new style of ETFs just because they're too risky and people tend to buy them just at the wrong times.
And an ETF itself, by definition, gives you an incredibly diverse range of underlying assets.
In theory, yes, but it does vary a lot. So looking at the range that we research, you've got some emerging market ETFs, for instance, that give you exposure to 1,800 different companies. So a huge spread. But then some of these more niche ETFs these days might only give you access to 20 companies, and they might all be in the same sector. And the problem is, if a sector's all moving in the same direction, you could see all of those stocks falling by 60, 70, 80%. And so they're maybe a little bit less diversified than people expect. And that's why we think research is important to help people understand them.
Are ETFs a good idea in such volatile times as we do have now?
It really depends on which ETF. So a lot of these more niche ETFs have been a terrible investment over the last 6 or 12 months and have lost investors a lot of money. So our research found that $100 million has actually been lost in the last year in thematic ETFs. And that's in a year that $10 billion was made in ETFs in total. And so it really comes down to, which ones you've chosen and the timing of when you invest. But we steer away from trying to time when to get in out of these things. And our advice is always, if you can, just to gradually invest over time, so to dollar cost average, because that's what's going to give you the best chance of earning, the market return over the long run. And, for our clients, that's meant something like a 6 to 10% return per year over the longer term of 5, 6, 7, 8 years. And that's probably what you can expect from a diversified portfolio in the long run. Obviously, there's years where particular assets or shares do very well, but unfortunately, they often don't last very long, and everyone seems to cram in right at the top and lose a lot of money then.
Okay, something else in the 8th annual Stockspot ETF report, which was interesting, I thought, was the stats about the number of women involved in ETF investing.
Yeah, it's one of the trends we're seeing within our business. ETFs, one of the benefits is that they're very much a hands-off investment. And so they're quite good for people that are time poor and that don't want to be actively trading the market. Now, I get the sense, and certainly from speaking to some of my friends and colleagues, that a lot of the interest in the share market over the last couple of years from people working from home, was more to fulfill a bit of a gambling need. And there was a lot of people that were very interested in speculating and trading shares, but they tended to be men. And it's the same if you look at the sort of people that use, the betting sort of apps, they tend to be very male skewed, and stock trading apps are the same. But what we're seeing is actually when it comes to ETFs, which are a lot simpler and easier to use, but also less risky, there's a much bigger group of women using them. So in our business, we've seen women investing in ETFs grow by 54% over the last year. And actually, of all of our clients, 43% are now women. And to put that in perspective, for most stock trading businesses, women only account for something like 16% of their users.
Wow.
So, I think it's definitely a positive trend. And ultimately, it's great because the women are investing in this sort of smart way that allows them to gradually grow wealth over their long run and probably outperform their male counterparts in a lot of areas where they're trying to speculate or gamble on shares.
Chris, thank you for talking to Fear and Greed.
My pleasure. Thanks for having me on.
That was Chris Brycki, founder and CEO of online investment advisor Stockspot. This is the Fear and Greed Daily Interview. Remember, you should get professional advice before making any investment decisions. Join us every morning for the full episode of Fear and Greed, Australia's most popular business podcast. I'm Sean Aylmer. Enjoy your day.